If you were watching the stock market in the final 30 minutes of trading this past Friday, you witnessed absolute slaughter. Massive block deals hitting the tape, blue chip giants sliding in a straight line, and a staggering 21,100 crore rupees dumped by FIIs in a single day. If you panicked and hit that sell button, you played right into a brilliant mechanical trap. Welcome to Market Insights by Prakash. Today, we are peeling back the curtain on a hidden market force. This crash wasn't about bad earnings. It wasn't an economic crisis. It was a cold, calculated, robotic execution driven by just four letters MSCI. Quick reality before we dive into the data. Our analytics show that 90% of our regular viewers haven't hit subscribe yet. If you value these weekly data packed insights, hit that button now to support Market Insights by Prakash. In the next 5 minutes, I'm going to show you exactly how this invisible system works, the precise stocks that just had millions of dollars forced into or out of them, and crucially, the one specific blue chip stock that this chaos just pushed into the massive buy zone. Let's get straight into the data. First, what is MSCI? Think of it as an ultimate exclusive VIP guest list for global investors. MSCI doesn't manage a single rupee. They don't buy stocks. They are a data company that writes a list of top investable companies in India. But here is the multi-billion dollar catch. Trillions of dollars globally sit in a passive ETFs and index funds run by computers. These computers are legally bound by global financial regulators to copy MSCI's list perfectly. Rule 1. If MSCI adds a stock to the VIP list, the computers must blindly buy it. Rule 2. If MSCI removes a stock, they must instantly liquidate it. They do not care about valuations. They do not care about management. It is 100% compulsive. If they don't execute at the exact closing price on rebalancing day, the fund suffers from tracking error. The managers get penalized and institutional clients pull their billions out. Because market move, MSCI recalculates this list every few months. This past Friday was execution day for their massive semi-annual review. But remember, these funds don't magically get brand new cash for this. It's a closed loop. To buy the new winners, the algorithms are forced to violently dump the old ones. Let's look at the raw institutional data, who got the cash and who got slaughtered. First, the forced additions. Global ETFs were forced to flood these stocks with capital. Federal Bank, the massive winner of the day, absorbing nearly $500 million in passive inflows. MCX pulled in a cool $370 million. Nalco and Indian Bank both locked in over $200 million each in pure non-negotiable buying. Now look at the exclusions. These companies were stripped of their VIP status, forcing ETFs to dump their entire holdings into the closing bell. Hyundai Motor India suffered a brutal $280 million forced exit. Jubilant Foodworks, Kalyan Jewellers, and RVNL all completely axed, triggering an avalanche of $110 million in selling pressures each. But here is what 99% of retail investors missed on Friday. Selling those four stocks didn't give the algorithms enough cash to pay for their new additions. So what did they do? They had to trim the fat from our biggest market giants. Look at Bajaj Finance, Hindustan Unilever, and TCS. Excellent businesses, right? No bad news on Friday, yet their price slid. Why? Because MSCI trimmed their percentage weight in the index to free up cash. Millions of dollars of blue chip stock were dumped by robots purely to fund the purchase of Federal Bank and MCX. So if foreign algorithms dumped over 21,100 crores, why didn't the market completely collapse into a circuit limit? Because of the other side of the ledger, the DIIs. Our domestic institutional investors knew exactly what the foreign computers were forced to do. While FIIs were selling blindly to satisfy an index rule, Indian institutions stepped up and bought a massive 16,764 crores in the cash market. They absorbed the shock. This brings us to your core retail strategy and the specific blue chip opportunity I promised at the start of this video. When a high quality cash generating giants like TCS or Bajaj Finance falls 1.5 to 2% in the final 30 minutes of MSCI rebalance, it is a mathematical anomaly, not business failure. It creates a temporary price distortion. Smart money uses this mechanical selling as a golden entry point to accumulate blue chips at a discount, knowing the artificial selling pressures vanishes the very next morning. The next time see you late day madness on an index review day, stop, look at the data, and realize that mechanical selling is a retail investor's best friend. Did you spot this distortion on Friday? Did you buy the dip in any of these trim giants, or did you hold through the storm? Drop a comment below. Hit that like button if this clear data breakdown saved you from panic selling. Subscribe to Market Insights by Prakash for institutional tracking you won't find anywhere else. And I will see you in very next data update. Stay objective, stick to the facts, and happy investing. Thank you.